Schwab Asset Management is proud to support the Inside ETFs podcast. As one of the nation's largest ETF providers, Schwab Asset Management offers insights and perspectives that can help advisors build on their ETF expertise. Did you know that more millennials are choosing ETFs as their investment vehicle of choice? Or that many investors plan to increase their allocation to fixed income, smart beta, and actively managed ETFs? Find out how ETFs can support your clients' goals with Schwab Asset Management's educational resources. Learn more at schwabassetmanagement.com/ETF know-how. Hello and welcome to Inside ETFs, the podcast where we bring the latest and greatest ETF industry perspectives directly to you through in-depth conversations with key thought leaders from across the ETF ecosystem. I'm your host, Douglas Yones, the head of exchange-traded products at the New York Stock Exchange, the home of ETFs. Now, today I'm joined by Will Rhind. He is the founder and CEO of GraniteShares. An 18-year veteran of the ETF industry, Will has brought his energy, his wisdom, and his financial industry passion to ETFs when he founded his own firm in 2016. The GraniteShares lineup is broad and successful, and I'm excited to have him here with us to discuss the markets today. Will, thank you so much for taking the time.
Doug, thank you so much for having me. Pleasure.
So, Will, I want to kind of start at the beginning, if I can. You've been in the ETF industry for quite some time. How did you get here? When you look back at your career, was there sort of this pivotal moment that said, hey, yeah, I'm going to be in ETFs?
Probably the more real answer is that it was right place, right time. And I say that because I started out in investment banking, was my first job out of college. And like a lot of people, you go into a big institution and you get sort of shuffled around a number of different jobs with a view, obviously, to picking some sort of specialization. But I did a year and a half I worked for Nomura, which, as for some folks might know, is a Japanese investment bank. And did a year and a half there and then decided to move. The culture wasn't necessarily the right fit for me. And so I wanted to move and found an opportunity with a firm called Barclays Global Investors. And obviously coming from the UK, and this was happening in London, I was told that this big asset manager that you probably never heard of, one of the largest asset managers in the world. And at the time, I genuinely didn't even know that Barclays had an asset management business. And obviously was very familiar with them as being a UK bank, but that was really about the extent of it. So I joined Barclays Global Investors, as it was called at the time, and really had a junior sort of sales position there. And kind of unbeknown to me, the firm was working on the first ETFs, in the US at the time. And so how it kind of intersected with my career was we started launching the first ETFs in Europe. And because I was on the sales side at the time, I was responsible for selling what was then just a product in the bag of a number of different products, including mutual funds and hedge funds and cash funds, etc. And because I was kind of at the coalface, so to speak, I was talking to clients on a daily basis about all the products we had, and clearly could see that there was a lot of interest in this nascent ETF product. And so, long story short, the group that was launching these products really internalized and rebranded, if you will, as iShares. That became a separate business within Barclays Global Investors, and I was one of the first people to join that in Europe, so one of the original team, and that's really how it took off. And I've stayed with the product throughout my career since that time, really.
It's always so fascinating. I love when we talk about some of the career pieces on this podcast, because I know a lot of younger investors sometimes listen in here. And I think it's so important, a lot of the statements you made, Will, right? Which is here you are, CEO and running your own firm. But in the beginning, you were very open to change. You were open to new roles and hey, let my passion drive me and let my interest drive me. And I think that's fantastic. So 2016, you launched GraniteShares. For an advisor who may not be as familiar with GraniteShares, might be familiar with your ETFs, but maybe not you. Can you share more about the firm?
Sure. So at its core, what GraniteShares does is we have to, and I say have to for a very specific reason, launched differentiated ETFs. And that sort of may sound like a marketing tagline, but it's not really, because as most folks will know that are somewhat familiar with the ETF industry, that the industry is dominated by a handful of players that are huge asset management behemoths, and therefore they have a lot of products, a huge amount of assets, but for the most part the products are fairly plain vanilla, or in other words are quite straightforward and certainly cover all the major bases in terms of equities and bonds. So where a firm like GraniteShares has to play is really in those parts of the market where they're certainly less competed than the broad benchmark space, the S&P 500s, etc., and where you can add value to investors by providing something different. So we kind of look at it through the lens of what we call high conviction investing. And really there are four things that we do kind of within that. So we do commodity funds, so different shapes and sizes of commodities, but everything from physical gold and physical platinum to broad market commodities, where you're investing in commodity futures. We do alternative income, so that's providing a very high level of income, or an income strategy through an ETF, but in a non-traditional way. So in other words, not from traditional equities or bonds. We have smart beta strategies, so providing a different take on large cap equities, trying to exclude losers as opposed to pick the winners. And then some leveraged single stock products, which are a new addition to our lineup, but providing amplified exposure on individual companies, both long and short.
So Will, you're focused in a lot of different places, but all very, very unique, right? And you bring a pretty high caliber team with you, right? I mean, you've got some really deep experienced people throughout your organization. Are you looking at the market with your team and focusing in a particular area? Do you look out and say, hey, it's October 2022, and here's what we need to be focusing in terms of the next product development trend?
Yeah, I think what I always say is, perhaps a different way to look at it is that it's never ideas that are in short supply. So we always have plenty of ideas. And a lot of people, I think, think about that or get that the opposite way around, which is they think that all companies are looking for is that next idea, and you have to think about what is the next product to bring out. I think from our perspective, it's never been about lack of ideas. It's really about what to prioritize on. And again, coming back to the business side of things, that we run a business, and that means that we have employees, we have revenue, we have everything that goes with that, and so we have to run a profitable franchise. And be able to grow sustainably. And launching funds is expensive, managing funds is expensive, marketing funds is expensive. I think for us, it's normally really about other strategies that we have still relevant for the market. Is there something that really resonates with investors at this particular time? Is that something we can focus on, as opposed to necessarily what the next sort of hot product might be? But clearly, it's something that, as I always said, we've never really suffered from a lack of ideas. It's just about what to prioritize at what time.
So as we start to close out on 2022, it's crazy for me to even be saying that. What do you look out at the market and say, hey, here's some of the bigger challenges for investors, for advisors, and maybe here's some ways, whether it be via ETFs or other, that investors could be managing their risks right now?
Yeah, I think look, this year has been a exceptionally challenging year, probably the worst year that most advisors may have seen in their career, on the assumption that they're managing something that looks and feels a lot like the 60/40 portfolio. And so what's the one accessible trade that's worked this year? And that has been long commodities. So long commodity product such as our COMB, just for example, which is just a broad commodity index. Think of it like the S&P 500 or something for the commodity world. But that's up double digits year to date, in a world where equity markets are down 20-25%, depending on what index you follow. So I think that's something that's still very accessible, but yet still under represented in clients and prospects portfolios. And one of the reasons for that, I think, is that perhaps people have been caught a little bit by the extent of the downturn and thinking that perhaps things would stabilize sooner. But we still have high inflation, we still have high commodity prices, and the supply issues that really were driving a lot of the price rises in the commodity market showed no sign of dissipating anytime soon. So I think commodities, having exposure to commodities in a high inflationary environment is something that everybody should be thinking about. Obviously, it will depend on each portfolio and everybody's appetite for risk, et cetera. But I think that's something that everybody should be thinking about at this particular time.
And of course, you can find out a lot of information about all the GraniteShares ETFs, and in particular, the commodities ETFs on GraniteShares.com. We're heading into year end, and one of the biggest topics that I keep hearing at conferences and in conversations is this idea about year end tax planning. It's been a tough market, and there's this sort of expectation, if you will, that we're going to see some tax planning and utilization of ETFs as a result of that tax planning could be quite large. Do you see it the same way? Are you and your team talking about tax planning and shifting between mutual funds and ETFs as we head towards the end of the year?
Yeah, it's something actually that we would do normally in the course of a normal year. It's just obviously it's been more challenging, particularly last year when we tried to do or to look at this particular part of the market, because most asset classes had experienced such significant gains. But what we're going to see this year, and we've already started to see it in different ways already this year, but is people looking to harvest losses if they have losses in the portfolio, and perhaps take that as an opportunity to book those losses with a view to offsetting them against gains. Or what we try and encourage advisors to think about is use it as an opportunity to clean up the portfolio, maybe move from a more expensive fund to a less expensive fund. And I say that's more relevant this year than it ever is, because I always say with advisors that clients typically don't put any pressure on advisors for the fees when they're making money. So when people are making money, typically they're happy, and therefore there's much less scrutiny on what advisors earn or the fees even in the portfolio. That changes when you're losing money. When you're losing money is the time when you start to think about the cost that you're paying, not just for your advisor, but the funds that you have within the portfolio. And certainly we field a lot of calls from advisors who maybe have an expensive gold ETF, are looking for an opportunity to switch out in a cheaper one like BAR that we offer, or broad commodities, again, where they're holding a more expensive broad commodity ETF, have losses and looking to switch into something like COMB. And that will just go across the board, I think. And there's one easy way for advisors to add value to a client who is upset about losing money or upset about fees, is a way to show that, okay, look, I have taken a look at your portfolio, and right off the bat, I'm able to save you some money just by moving some of these funds around, getting out of more expensive exposures and getting into cheaper ones.
Yeah, and this conversation comes up continually, and I think tax planning is finally starting to take center stage, but certainly has more opportunities to run. And I know it's a conversation I'm having in my own household. It's been a tough year, but is there a way to use that to your advantage, and can ETFs help? Will, is there an ETF in your lineup that you look at it and you say, boy, this just hasn't had the spotlight, or it hasn't gotten the attention that you think it deserves, and let's put a little light on that right now?
I think for right now, and one that I'm focused on, I think people should be paying much more attention to, is HIPS ETF, and HIPS stands for High Income Pass-Through Securities. So very simply, the elevator pitch is this is an ETF that is one of the highest yielding ETFs in the market, yielding 10% plus per annum at the moment yield. And it does that by investing in a diversified portfolio of pass-through securities. And pass-throughs are a type of security. Think of it as almost like a hybrid between a bond and equity to some degree, but they are made up of real estate investment trusts, BDCs or business development companies, MLPs or master limited partnerships, and other structures like closed-end funds. But the key is none of these entities pay corporate taxes, so you can automatically start at a higher level of income. What's unique about HIPS is it pays a fixed dollar distribution per month, and it pays the same distribution per month. And that's important because that means that when you buy it, if you buy it today, or if you buy it a week from now, or a month, or a year from now, that when you buy it based upon the share price, you'll lock in that income when you buy it. And so, you think of a value, or what's the value of something that yields 10% right now? I mean, I would argue it's pretty high in this particular market. And what's interesting is the composition of HIPS. You have some real asset income plays in there because part of the exposure is in against real estate, part of the exposure is in MLPs, which are typically oil and gas infrastructure. So I think it's really interesting, particularly a time when, again, goes back to that people are much less now concerned about growth. And it, to a certain degree, we usually hear this from advisors and a lot of investors in the market, up until the last 6 months, I would say, where people would prioritize perhaps growth over income with the view that they could turn growth into income if they needed. So if the market, in other words, was always going up by double digits every year, why would you necessarily need or focus too much on income when you could always just sell some of those gains and convert that to income? Well, the challenge with that strategy was that, or is that, markets don't go up obviously every year. As people are finding out this year, perhaps what's even worse than markets not going up every year is now, if that's your strategy, you're going to have to convert by selling when the market's down the income, and there's some compounding losses, as opposed to going into a dedicated income strategy. So I think that's something that I would definitely highlight to people who are looking for income. The performance this year has been very good compared against treasury bonds, compared against high yield bonds. And I think a common question we get from people is always like, what's the catch? And we try and tell people that there is no catch other than clearly the value of the portfolio can go up and down. It's not a static portfolio. And so you are exposed to the market risks of those underlying securities. But look at the performance this year, and in a year which has been terrible for a lot of fixed income, particularly for government bonds, and a lot of the high yield sector, performance has been very good. So that's a strategy I think that now a lot of people come to us and are looking for income, want to prioritize income, want to be more conservative. So that's shoring up the balance sheet, their own personal balance sheet, more cash, more income generating strategies. And so I think HIPS is something that should be in that mix for consideration.
And as a reminder, if you want to learn more about HIPS, you can find it on the New York Stock Exchange's website, etfcentral.com. Easy to remember, etfcentral.com has a great, intuitive, for free ETF screener, and you can learn a lot about HIPS and the other GraniteShares ETFs there. Will, if an advisor, an investor, they're out there, they're listening in and they're saying, hey, I need to be connecting with you, I need to talk to your team, are there best sort of practices to engage with the GraniteShares group?
Not really. I mean, we're not a big firm. And so again, the beauty of dealing with a firm like GraniteShares is that you can just contact us directly. We have a chat function on the website. We are obviously very transparent in terms of phone numbers, et cetera, and emails. So, people can reach out to us very easily and speak to, human beings, as opposed to some of the bigger firms where, you might be on hold for hours and hours and never speak to anybody. So that's definitely a big plus of dealing with, a boutique firm where you can speak to us. We're very approachable. And if anyone's got any questions, we're always happy to talk people through what we offer and why.
And I'll second that, Will. I mean, very approachable. I've even had the opportunity to meet your family. You've been here a number of times to ring the bell at the New York Stock Exchange. I've got to meet your parents, your wife, your kids. Super friendly group, and that goes across the entire GraniteShares team. So welcoming. I love the chat feature on the website. Again, that's GraniteShares.com. Easy to remember and easy to find. Now, that is a wrap on today's edition of the Inside ETFs podcast. As a reminder, you can find this episode as well as many other episodes of the podcast on the New York Stock Exchange's website, etfcentral.com. I want to thank you again, Will, for your time, for being here to share your insights and some great ideas for advisors as they think about the rest of 2022. Please stay tuned for upcoming episodes featuring thought leaders from across the ETF ecosystem. I am Douglas Yones, head of exchange traded funds at the New York Stock Exchange, the home of ETFs. Schwab Asset Management is proud to support the Inside ETFs podcast. As one of the nation's largest ETF providers, Schwab Asset Management offers insights and perspectives that can help advisors build on their ETF expertise. Did you know that more millennials are choosing ETFs as their investment vehicle of choice? Or that many investors plan to increase their allocation to fixed income, smart beta, and actively managed ETFs? Find out how ETFs can support your clients' goals with Schwab Asset Management's educational resources. Learn more at schwabassetmanagement.com/ETF know-how.